Hello, novice traders. This is novice trader Cindy with investorshelp.net. Have you ever heard someone say that a stock gapped up or gapped down and wondered what that meant? This short video will explain to you what a gap is and also give you examples of a gap up and a gap down. First, let me start by explaining to you what a gap is. A gap is a break between prices on a chart that occurs when the price of the stock makes a sharp move, either up or down, with no trading occurring in between. There can be a number of reasons that cause a gap in stock. One could be buying and selling pressure. There could be a change in an analyst's outlook for that stock. There could be some type of news release on that stock, or very commonly, it could be because of earnings announcements. So let me show you an example of both a gap up and a gap down. I have chosen to use the stock Netflix because they are notorious for having gaps at earnings. So as you can see here, we have Netflix, and I have this on a daily chart. The first gap we'll look at is a gap down. Here is the day of earnings announcements on July 18th of last year. And then the next day of trading, which was on July 19th, you can see is way down here. So the area in between these two bars is the gap, because there was no trading in between these two bars. Now we will start with taking the low of the second bar to the high of the first bar so that we can see the percentage of this gap. So there is a 15.36% gap between the high of the first bar and the low of the second bar. Normally you would start with the first bar and go down to the second bar, but the reason I did it this way is because the information box there that you see at the bottom on the low bar is too high on the first bar and you cannot see the percentages. So that is why I took it from the bottom of the second bar to the top of the first bar. So that is a 15.36% gap if we measure that way. Now let me show you the other way that traders like to measure as well. Either way is correct, it just depends on your personal preference. So the other way is to take the low of the first bar, and now we're low enough we can see the box, and then you go to the high of the second bar. So that's a roughly a 10.59% gap. Either way is correct. Personally, I like to look at the entire gap, so I do it from the top of the first bar to the bottom of the second bar. But again, either way is correct. So that is a gap down. Let's take a look again on Netflix at a gap up. Clearly you can see when you're looking at the bars on this chart where the gap is. Here's earnings, and the day of earnings it closed on a low, but as you can see the next day there was a gap up and it closed on a high. So let's go ahead and measure this percentage, and first we'll do it the way I do it. The low of the first bar to the high of the second bar. So that is a 21.2% gap that way. Or we can look just at the actual gap itself and measure that. We'll take the high of the first bar to the low of the second bar, which is roughly 14.55%. So let's see if we can close this, make it a little smaller so that you can see both the gaps together. Here is the first gap that we took a look at right here. And then here is the second gap we took a look at. Oh, circles are a little bit off, but you get the idea. So here we had the 15% gap down in July of 2016, and just 3 months later we have a 22% gap up. So that shows you one of the dangers of buying and holding stock over earnings. And I have to say that I have bought and held stock, Netflix stock, over earnings, and I have been on both ends of this. I have experienced the gaps down, which are not pleasant, but also the gaps up, which are pleasant. So if you have a high tolerance for uncertainty, then you would be okay to trade earnings. But that's a simple explanation of what a gap up and a gap down is. And I hope you found this information useful and helpful. And you have a great day and happy returns.